increase income, decrease costs, extend, ICE, your mortgages. All right. So for the first one I'm going to talk about is I'm going to offer you, remember, smorgasbord. Whole bunch of ideas. Some will work, some won't work. The best thing you need to do is you need to seek professional help. By all means, I'm not talking professional help as in laying on the couch and, so tell me about your fascia. It's not that kind of professional help. We're talking about seeking professional help, being a mortgage broker, somebody who understands this game, somebody who's in this business to help you out, seeking that professional help. Here's an opportunity which I will break down into a little bit even more because I had some people asking me this question about convert amortized loans into interest-only loans. It's a short-term strategy, and I will break that down a little bit further for everybody here. Maybe there's an opportunity for you to consolidate some debt. Some outstanding debts, car lease payments. Maybe you take a property, you have lots of equity, you get one line of credit or you get one capital against that. And then that one capital pays off like 5 or 6 or 7 small other lines of credit, plus maybe a car loan, stuff like that. Okay, you consolidate into one payment. Typically, having one payment is lower in a monthly nut to pay than having 7 different payments over 7 different instruments. And then here's a strategy that somebody recently shared with me. So the simple concept is being able to port the mortgage. So the person was out in Eastern Canada, had a property they wanted to sell. And what they were going to do is start pivoting to a new marketplace. So they're using a lot of these strategies already. They're pivoting to a marketplace that's more business friendly, that they can buy properties at less of a price point, that have a greater chance of cash flowing. Okay, so the person was able to sit there and contact their bank, sell the property. When they sell it, they're going to port that mortgage. Why would they want to port that mortgage? Because they have a really low locked-in interest rate on that porting of that mortgage. And then they're going to port it over to a new property or a bigger property with more units in the new marketplace that has a greater opportunity of cash flowing. They're going to port that low interest rate over to a new property, and they'll have a wonderful new property that will cash flow because they ported over their mortgage. All right, so that's a strategy there as well, is just porting over your mortgage. So the next one I'm going to share with you here is the following. We're going to talk about potentially, now a couple of these are really short-term Band-Aid solutions, like skip a payments. This one is a really short-term Band-Aid, kick the can down the road kind of a thing. Many banks will offer you a skip a payment option. If you're able to skip a payment on a property, what they do is they just take the interest for that month, they add it to the principal, and the best one for this is RBC. If you have any RBC mortgages, I think every 12 months, honestly, with just a click of a button on their website, you can potentially skip the next month's mortgage payment if you qualify for it. Okay, I'm doing that right now. Actually, a partner of mine. One of my partners right now, he's turning in his 80s and he's looking to exit. He just wants to clean off the books and get rid of everything. And so we're selling a property, and the property just went vacant on that. So next month, we're going to skip the mortgage payment on that property while we're selling it. Okay, so that will add another, save us I think it was like $900 for that next month. Well, there's no rent coming in and we're trying to sell it, let's try to save some capital. So we did a skip a payment on that as well. Okay, so that's the one thing I want to do is talk about skip a payment. The next thing I want to share with you is maybe there's an opportunity for you to extend the mortgage principal. And I've heard this, and I've just heard from people that literally just went into their branch, like went into the bank that holds the mortgage and just saying, I know the payment's gone up and stuff like that. What can you do? Is there a possibility to extend this out to 40 years or 30 years? And I have some math I'm going to share with you here again. Extend it back to original amortization, which is the next one that we're going to talk about here as well. But encourage you not to just lie down and just take it. Like, by all means, go talk with the bank that holds a mortgage and ask them what options they have. I had a conversation with a mortgage broker the other day, and he shared there's lots of lenders out there that will offer 40-year amortizations. Now, don't get upset when the rates are even higher, or maybe you have to pay some fees and stuff like that. But extending the amortization is a wonderful way of lowering the payment. The next one is the renewals. And this term is something I learned, and I use it quite often and have used it quite often over the years, is when you say you have a property and you bought it, it started at 30-year amortization, and then 5 years later, if everything goes according to the schedule, there should be 25 years left on the amortization. At renewal time, I went back to the bank and said, are you okay if we extend it back to the original amortization of 30 years? And in some cases, you have to requalify, reapply. In some cases, honest to goodness, it was just a paper shuffle, some signing documents. It was really simple. But if you're taking something, so obviously you started at 30, you paid it down for 5 years, the balance is lower. So you're taking a lower balance and then extending it back out to 30 again. Your payments will go down. Okay, now that's what I'm going to share with you here is let me share a little bit of math here with you. So let's have some fun with some mortgage math fun. So in this first slide over here, this is a $400,000 mortgage at a 5% interest. Let's say I'm diligently paying it down, and over the last 5 years, it's been accelerated because a lot of was going to the principal pay down over the last 5 years. And then what you would do is maybe you revert back to the original 30-year amortization. There's a $575 a month difference by taking it and reverting it back to an original 30. That's just one example. Now let's take this example. So let's say the example was that it was 25 years, so it only went down in 5 years in amortization. Right there is what is that? A couple $100, $291 difference between that of just taking it. You've been paying it down for 5 years. There's 25 years. You revert it back to original amortization of 30 years going there. Now, maybe there's an opportunity you can take that out to 40 years. Or maybe there's an opportunity. Maybe you have a multifamily with 5 or so units on the property. Maybe you can apply for the MLI Select program from CMHC and you can take it out to 50-year amortizations. Okay? So just being engaged in the process, having those conversations with your lenders, which is absolutely critical as part of the process. Now, this next one I'm going to share with you is the readvanceable mortgage strategy. This one was shared to me by our good friend of the YouTube channel, my YouTube channel and podcast, Dalia Barsoom. Now, gang, if you're following along my podcast, Dalia on a weekly basis shares these wonderful mortgage financing tips. Like they're in and of itself, just like that's 3 to 7 minutes of that mortgage financing tip. That's just gold that we cut into that on the podcast. So I would highly encourage you to make sure you take a look at that. So within that, there's wonderful tips, and one that she just recently shared was on this readvanceable mortgage strategy. Now, I'm going to walk you through it in concept, okay? But this is essentially the simplest way to describe this is how you can take a mortgage that has a principal and interest component to it and turn it into an interest only. And this is something I've been walking through with some of my clients, but Dalia did a wonderful job on my most recent podcast episode of sharing this with everybody. Okay, so what we do here first and foremost is number one is you may have to convert your mortgage, right? If you don't already have one of these readvanceable mortgage products, for example, like I said, Scotia has a STEP program. RBC has a wonderful program. A lot of banks out there have readvanceable mortgage products. Simplest way to describe it is you have a mortgage, interest, and principal. You also have a line of credit that's attached to it too. So you have a mortgage and you have a line of credit. As you pay down the mortgage, the line of credit balance goes up. Okay, that's the simplest way to describe it is that way. So maybe you have to convert a mortgage to a readvanceable product. Then each month, as you pay it down, like I showed with my hands, was each month you pay it down, the principal goes down, right? And then the interest will start, each month you pay it down, the principal balance goes down and you get it readvanced to the line of credit would be the best way to say that. Right, I said, as each month you pay it down, you get advanceable more money to your line of credit. And then what you potentially can do is you can take that accessible capital on your line of credit and convert it into cash in your bank account. Now, understand that this is just a short-term solution. It really is. It's one of those Band-Aid, kick the can down the road a little bit, but it can definitely help. So think about this for a second. So every month, the mortgage gets paid down, okay? Every month, the line of credit balance goes up of available capital. So potentially what you could do is, let's say every month or maybe every 6 months, you take that, and let's use real life numbers. Let's use numbers. So let's say your mortgage payment was, I'm gonna just simple numbers, $2,000 a month. 1,000 went to interest, 1,000 went to principal reduction. Okay. Every month, in theory, you should be getting another additional available capital in your line of credit of $1,000 a month. Okay. So let's say after 6 months, you have $6,000 available. You take that $6,000 from the line of credit, dump it into cash in the bank. So you now have the next 6 months of cash requirements. Now and some of you going, well, Russ, but you're raising your amount of capital on your line of credit. Well, let's just do some quick math. So $6,000, and let's say it's 5% interest, $300 divided by 12. That's an extra $25 a month in cost. So you can get access to $6,000 for $25. Okay. For a $25 additional cost. What you're really just doing is you're putting cash in the bank to help absorb the tighter cash flow for the next 6 months. And then hopefully within the next year, you're able to raise your rents. If you're in a marketplace where you can raise your rents, maybe get a tenant out that's under rented, and you're able to then absorb that. And then a year from now, you go back to the original amortization where you're not having to pull out that capital. Like I said, this is a strategy for you to use. You know, I'm not saying desperate times, but sometimes no stone unturned. You just have to look at everything. So this is a wonderful strategy for you to incorporate. Make sure you talk to a good qualified mortgage broker to make sure it makes sense for what you are doing. I sure hope you enjoyed that segment from a recent podcast episode. If you don't want to miss another episode, make sure you subscribe. There will be a subscribe link right here. And if you want to watch another segment from that episode, there will be a link up here, or you'd like to watch a playlist of the full long form podcast episodes, there'll be a link down here. Enjoy.